Hi, everyone. You're all welcome. Here is pros and cons accountancy tutorials. As you may be aware, my name is Edward, and you can call me Ed. Today, we want to continue with our consolidation lectures, or let me say our consolidation tutorials. So far we've done about 3 mechanics, and we want to continue with the 4th mechanic. If I say mechanic, maybe if today is your first time, we are dealing with business combination, what we may see at consolidation in class. So when we started mechanics, we said we have about 6 mechanics that we need to know before going into any exams to write either financial reporting or corporate reporting or any course or subject which may bring about reporting or consolidation. So one mechanic we made mention was your group structure, which we've dealt with. We also made mention of the date of acquisition and date of reporting, which is also one of the second mechanic that we'll talk about. Then our third mechanic was the cost of consideration. So we've used about 3 meetings to deal with cost of consideration. So please, if let's say you've not watched the video, you can go back and watch those videos. We dealt with the 6 costs of consideration that we may have in our consolidation question. One being cash consideration, another being the contingent consideration, another being deferred consideration, another one as the exchange of asset, maybe transfer of PPE or so. Also, we have the share exchange, and lastly, we will have the loan consideration. We've dealt with all this with questions, or let me say scenarios. So you can go back, look at those videos or watch those videos and get understanding on these things. Now, our focus is on the net asset schedule of the subsidiary. Net asset schedule of the subsidiary, what we said to be our 4th mechanic. So today, that's what we want to deal with. So the question we ask ourselves is, what is the net asset schedule? As a parent company, if I purchase another company being the subsidiary, I would like to know their net asset, right? We made mention that with the group structure, after the parent has purchased their own, whatever will be left, we call it the non-controlling interest. So if let's say the parent purchased 60%, whatever is left, the 40% left is the non-controlling interest. So these people would like to know the net assets that they've purchased within the company, right? And also, so net asset at acquisition. That's the net asset at acquisition. Then at the end, they will also want to know what is the net asset at the end of the year. So we have the net asset at acquisition and the net asset at what? At the end of the year. Now, end will be different from acquisition. So surely the difference is what we call the post-acquisition asset or the post-acquisition profit. The post-acquisition what? Profit. So what you are going to say is that we have net asset at acquisition, net asset at reporting. Then the difference between reporting and acquisition, we term it as what? The post-acquisition profit. Why are we saying that? The idea is that from the time I acquired you, right, to the time of reporting, surely there may have been some changes. So the reporting figures may not be the same as what? Acquisition figures. Then in that case, we say the difference is a post-acquisition. Post-acquisition to the sense that from the time I acquired you to the time of reporting, this is the difference. So that is the post-acquisition, after acquisition, what has happened? What has happened or what has changed after acquisition? So basically, that is the post-acquisition period. So that explains the net asset schedule, right? Okay. So with the net asset schedule, we will say that, okay, then it means we want to know the net asset within the organization. So we can use the asset column to do. But the question we ask ourselves is, we are talking about net asset, right? If a question is given to you, let's say a financial position is given to you, normally that financial position given to you gives you ending values of asset. So that ending values of asset, if we should pick, then it means that that is the net asset at the end alone. What about acquisition? What about acquisition? So it will be very difficult for you to get that of acquisition. Okay. How then do we get net asset? How do we get net asset? So net asset could be your total asset less what? Liability. So your total asset, then you less out liabilities, then you get what? Your net asset. If let's say we've done ratios before or financial analysis, right? Financial statement analysis, ratios. You will see that if you are dealing with return on capital employed, it is your profit before interest and tax divided by capital employed. This capital employed is a net asset. And that net asset is your total asset less current liabilities. Your total asset less current what? Liabilities. Now, let's put that one down. If we take your total asset less your liability, it gives you your equity. Your total asset, if we should less liability from it, you are going to get your what? Your equity. So the question is that, okay, fine. Then let's use the equity instead of what? Instead of the asset portion. Because we are saying that net asset is total asset less liabilities. And that is the same as what? Our equity. Then we can use the equity side. Because for the equity side, we will get beginning or acquisition, and then we will get what? Reporting. Why am I saying we will get beginning and we get reporting? Because for your equity, we have the shares, we have the retained earning, and you know that retained earning keeps on changing. And that is what will even bring what? The post-acquisition profit. The post-acquisition profit. Let's get this in mind very well before we start. Right. So you will see that, let's look at this. So you see that for your net asset schedule, we are going to have acquisition. We are going to have reporting. And we're also going to have the post-acquisition. The post-acquisition. So acquisition, reporting, and then the post-acquisition. So it means if we are saying the equity, then we are going to use our ordinary shares. Our ordinary what? Shares. And aside our ordinary shares, sometimes in your financial statement, you may have share premium, which is also part of your equity portion, right? And you may have retained earning. So all these form part of what? Your equity. All these form part of your equity. So you need this. And this is, in fact, this is your net asset schedule. Okay. But you know that surely these things that you are seeing here may be the same as here. What you are seeing at acquisition may be the same as what? Post acquisition. But just that because we have retained earning may change. Retained earning may change. Right? If you have shares and you do not issue another, then it means that the ordinary shares will be the same thing, same as your share premium, also going to be the same thing. But your retained earning may change at the end of the year because Retained earnings as a result of combination of all profits from what? Several years, different years coming together to make what? Retained earning. So this year's own will be added to what we had at acquisition to give us what? The post acquisition. So surely acquisition figures may be different from post acquisition figures, but you should know that your ordinary shares and share premium may remain the same because we've not had issued. And normally in your consolidation questions, there's nothing like what issuing new shares before we start the consolidation. It doesn't happen like that because it is a company you are going to what? You are going to purchase. If you are purchasing the company, how does the company now issue again? No. So it is the same shares you are going to purchase at acquisition. And that same shares will be there at reporting. The same share premium will be there at acquisition. It will be there at reporting. It's not all questions that you are going to get share premium. There are some questions you will not get share premium. And for those writing the professional paper, sometimes it's even difficult for you to get share premium, right? Most of the questions don't bring what we call the share premium. So this should have been our net asset schedule. So now, what happens here is that, okay, I am the one purchasing this company. This is the acquisition figures. At the end, this is what I'm seeing. But let's look around and see. Is there any other differences that should have been added? Because this is just, let me say, somebody will say, this is just the overview. This is what you just use your eye to see. This is what you've just seen. Let's delve into it. Go and look at it critically and see if there are other differences, other changes which should have been added or subtracted from from this schedule. So then we go to the market or we check around and see if there's any fair value adjustment. If there's any fair value adjustment. So what are those fair value adjustments? Well, it may be that some asset that we purchase from them it may be that some asset that we purchase from them, the value has gone up within the period, or the value has reduced within the period. And if the value has either gone up or reduced, then it simply the value has either gone up or reduced, then it simply means that the depreciation may also be affected. The depreciation may also be affected. So let's say that at acquisition, the time we purchased the company, there was this asset they gave to us, which was, let's say, 10,000. Not knowing it was supposed to be at 12,000. But within the year, we were charging depreciation based on the 10,000. What then happens? It means that there's a certain asset we've not added, that 2,000 has not been added. And also the depreciation is also low. So we need to do that adjustment. And that's what we call fair value adjustment. Now, remember, this could have been our net asset. So if there's also, and we said net asset is as a result of what? The asset less what? The liabilities. So if there's also any liability outstanding, though this is the asset less liability, but there may be any outstanding liabilities too that they've not taken care of. So what do? You have to also take care of those assets, right? And there are some circumstances where a question will be given to, a scenario will be given to, where you see that the subsidiary also sold something to who? To the parent. The subsidiary sold something to the parent, or the subsidiary sold something to the associate. So if the subsidiary has enjoyed any profit from this selling, we said we are buying you. So if, let's say, you sold something to X and then made a profit, no, you can't be a profit. You can't make a profit from S. So we will have to rewind. We will have to rewind. That is also the idea on the net asset share. So normally you will hear what we call provision for unrealized profit. That is provision for unrealized profit. So when we come to the fair value adjustment, When we come to the fair value adjustment, we may have any asset at all. We may have PPE, so changes in PPE, or what other investment property. We may have any asset that you can think about, or intangible assets. It may be that they gave it to us at a certain amount and it was supposed to be at a different amount. So the difference will now be added to our assets. Will now be added to our assets, right? Good. And also we call something um, additional depreciation, as I first mentioned. Additional depreciation. Why are we talking about additional depreciation? Because a change of the asset has come. Now we've gotten to know that the asset should have been more than what you gave to us. So if we were depreciating, if let's say the asset was left with 5 years and you gave it to us at 10,000, right? And we're depreciating with the 5 years, it is what? 2,000 per year that we know. So that 2,000 per year is what we've used in doing this, in coming to what we see here, right? So this, we call it book value. Book value. Let me put it there. I call it book value. Okay. So now, this 2,000, the difference. So this is depreciation, this 2,000 depreciation. So let's say the asset was supposed to be 15,000 instead of the 10,000 you gave to X. Then it means there's a difference of 5,000 that we didn't know. A difference of 5,000 that we didn't know. So that difference of 5,000. So that difference of 5,000, we also have to calculate depreciation on that difference of what, 5,000. Because we will have to get what? The difference. We will have to get the additional depreciation. So we have something we call additional depreciation. And know that we don't calculate depreciation at acquisition. You can't just purchase an asset and you depreciate it. So that additional depreciation will be at the end of the year. At the end of the year. Now, what you have to know is that at any point, it is reporting minus acquisition, which gives us the post-acquisition. Reporting minus acquisition gives us what? The post-acquisition. So if we have a negative here at reporting, we have a negative figure at reporting minus post-acquisition, minus acquisition, which is 0. It means we are going to have a post-acquisition of what? Also a negative figure. So that's what we have to put in mind. So always it is reporting minus acquisition. Reporting minus acquisition. Okay. So if you come to the fair value adjustment, the PPE, if the difference was, let's say, 1,000, it is 1,000 added to the asset and then 1,000 added at beginning and also at acquisition reporting. So 1,000 minus 1,000 will give you what? 0. Will give you 0. Okay, so we should have that in mind. All right. So as I said, if there's any thing that if let's say the subsidiary shows something to the parent, shows something to the associate, made a profit, that profit we will have to take it out. We will have to take it out because you are not supposed to make any profit. So that profit will be part of what? The retained earning, or let's say it will be part of the book values that we have. So we have to take it out. So we call something PUP, which means provision for unrealized profit. You have to unrealize the profit. You have to unrealize what? The profit. Okay. As I said, if there's any liability that they've also not settled, you will have to take it out. So any liability, it can be deferred, any deferred something that they've done, or let me say deferred tax. It can be a deferred tax. So if it's a tax that they've not paid, it's a deferred tax, you have to take it out. Any other liability, if you've done IAS 16, let me even not go there. But if you've done IAS 16, which is PPE, you will see that we have something we call we have something we call site restoration cost. Site restoration cost. And this site restoration cost is part of the cost of the asset. But remember the name, site restoration, meaning it's a future cost and it's a liability. So if they have not settled this, also it's a liability. You will have to subtract any liability at all. Right. So after that, we come and get the total figure and get what we call net asset schedule. The net asset what? Schedule. So that will be all for the net asset schedule. But as we always do, we will have to take a scenario and go through the net asset schedule, right? Because normally what students face is that when they are dealing with the retained earnings, they find challenges over there. But we will try our best and deal with all the retained earning differences that you may get. Because normally when a question is given to you, if it is a profit and loss, profit or loss, how to get a retained earning is different from if it is a financial position. But we'll try our best and make sure we do it all. So let's take a scenario. Now let's capture this in mind so that we take a scenario and deal with it as easy as possible. Right. Okay. So let me share this question with us. Then afterwards, we can look at the question and see how best we can deal with the net asset schedule. I think that has been our question for consolidation so far. We have about 3 questions to deal with in terms of, but we are using it just to come out with all the mechanics. So don't get intimidated. We will deal with it one by one. Then if we finish and there's time, we will solve it in a whole. We'll solve it in a whole. All right. So let's look at this question. On 1st October 2010, Cheddar secured a majority share of what? Oba on the following terms. An immediate payment. So this is just talking about what? This is just talking about the terms of payment. So an immediate payment of 4 per share on 1st October 2010. And then a further amount deferred until 1st October 2010. So please, it is until 1st October 2011 because you can't defer the same period. So it is 1st October 2011. 1st October 2011. If not, then I'm coming. The time of purchase is supposed to be 2009. Let me first look at okay. So the time of purchase should be October 2009. Sorry for the mistake. The time of purchase should be 1st October 2009. 1st October 2009. 1st October 2009. Sorry for the mistake. So here too will be 1st October 2009. All right, let's continue. Now, the immediate payment has been recorded. I think we've dealt with this question, so it will be better for us to go straight to the net asset schedule of the subsidiary. All right. So we said for the net asset schedule, the first thing we are looking at is what? We are looking at is your ordinary shares. So if you look at the ordinary shares, it is 10,000 for the subsidiary. But we always have to be careful because they said net equity shares of 1 Ghana cedi each. What if it was 2 Ghana cedi each? It tells you that this shares is what? 20 cedis. This shares will be just 5 cedis. Well, if it was 2 Ghana cedi each, if we multiply by the number of shares, it will be just what? It will be just 5,000. Let's explain this very well. Now, this is 1 cedi, right? This is 1 cedi. So if we divide, what you see here is an amount. It's not just the shares, it's an amount. So if you divide 10,000 by 1, it gives you the same 10,000, right? But if here was 2, and you divide here by 2, you get what? You get 5,000. So the shares would have been 5,000. But here the shares is what? 10,000. That's not our focus. We just need the amount. So let's go to the board and then capture the amount. Let's go to our board and capture the amount. So we have net asset schedule of the subsidiary. First, we say we have to get the acquisition, we have to get the reporting, and then we have to get a post-acqui profit, isn't it? So we have our ordinary shares, and we know that it was 10,000 at acquisition. So there will be nothing here because 10,000 minus 10,000 gives us what? Gives us 0. Okay. We said there may be a share premium, but this question does not have share premium. So we have to get retained earnings. I have to get retained earnings. So let's go back to the question and look at how we are going to get our retained earnings. Our retained what? Earnings. So if you look at the question, the retained earnings as at the time that we acquired the company. As at the time we acquired the company, look at here. The time we acquired the company, the retained earning was how much? And how much is the retained earning at the end of the year? So this is retained earning at the beginning of the year. At the beginning of the year. At the beginning of the year, which is at 1st October 2009. Sorry, this will be 2009, whilst this will be 2010. Right, let's do that adjustment before. This will be 2009, and then the ending, sorry, this will be 2009, and then here will be 2010. Because you can't purchase at the same time and then consolidating at the same time. No. Right, so let's take that into consideration for me. By the next video, we will try and then do the adjustments before we come. Okay, but today, let's try. So as at the time, the 1st October, it was how much? It was 12,000. And at the ending period, it was how much? Because we have added, they say for the year ended. This is profit for the year ended. As at the year ended, we had a profit of 6,000. So if she add the 12,000 to the 6,000, we are getting what? 18,000. So it simply tells you that the beginning was 12,000. At the end, we have gotten another 6,000 to add up. So 18,000. Now the question you ask yourself is, this 6,000 you are seeing is 12 months profit. So did the parent purchase the company for 12 months? That's the first question. Did they purchase them for 12 months? Yes. Because if I should purchase you on 1st October and the reporting date is 30th September, it tells us that it is 1 year. So let's count. October, November, December, January, February, March, April, May, June, July, August, September. That's 12 months. So they have purchased them for how many months? For 12 months. So let's go and deal with that. They have purchased them for 12 months. Okay. So we have 12,000 as at acquisition and then 18,000 at reporting. So it tells you that the post-acquisition, which is 18,000 minus 12,000, will give you what? 6,000. 6,000. So this is our book value. Our book value. 28,000 and then 22,000. This is our book value. This is our book value. Now let's go and see if we can get any fair value adjustment. Fair value adjustment. Fair value adjustment. So in that case, we have to go into the notes and see if there's any fair value adjustment, right? Good. Let's see if there's any fair value adjustment. Then we can deal with that and then look at other issues. So let's go to the notes. They said Cheddar's policy is to value the non-controlling interest at fair value at the date of what acquisition. For this purpose, the directors of Cheddar considered a share price for Uber of 3.5 per share to be appropriate. So here they are talking about the acquisition and also talking about what? The consideration, right? The consideration. So that's not a focus for now. At the date of acquisition, the fair value of Uber's property, plant, and equipment, let's listen to it very well. they were equal to what its carrying amount, with the exception of Ober's what plant. So there's a certain plant which had a fair value of what 4 million above its book value or above its carrying amount. So Cheddar should have given us, Ober should have given us that asset plus the 4 million. But it may be that Ober himself didn't know that the fair value at the market has increased. So Ober just gave us what? Just gave us the book value as he has in his book. But when we went to the market, we have gotten to know that, oh, this asset or this plant that Ober gave to us, let's say 10,000, it has another, it has increased, or its fair value has increased by what? 4 million. So that is a fair value adjustment. So we will have to add it to acquisition and also add it to what? To the reporting, because as at the time we are acquiring, Ober didn't know that it has increased. So we now have to do what? The needful and do the increment. That's the idea there. Okay. Now let's continue and see what will happen. So we have the 4 million above its current amount, and they are saying that at that date, the plant had a remaining life of what? 4 years. So as at the date of acquisition, the plant had a remaining life of 4 years. What does that mean? It means we were depreciating whatever Cheddar gave to us by 4 years. You get it? Now additional 4 has come, so we have to depreciate that additional 4 also by 4 years. So the additional depreciation will be what? 4 million divided by what? 4 years, giving us 1,000. So let's go to our note, or sorry, let's go to the board and look at other things. Or better still, let's complete reading the note. So they are saying that Ober uses straight line depreciation for plant, assuming a nil residual value, because you know depreciation, you have to know whether there's a residual value or not. But Ober uses the straight line and there's no what? Residual value. Also, at the date of acquisition, Cheddar valued Ober customer relation. So there's a certain customer relation for which Cheddar has valued it, because for Ober was not valuing it, right? But when Cheddar came, Cheddar got to know that no, there's a certain customer relation as for which we need to value as a what? As intangible asset. So it means there's also an intangible asset again. And I made mention to you that this this fair value adjustment, the asset can be any asset. So there's intangible asset as well. Okay. So Cheddar valued Ober's customer relationships as an intangible asset at a fair value of 3 million. And then Ober has not accounted for this asset. So it is not part of the asset that we know. Trading relationship with Ober's customer lasts an average of 6 years. So they were just telling you that it will last for 6 years. It will last for 6 years. So if you want to amortize, we don't depreciate intangible assets. The name for its depreciation is called what? Amortization. So if you want to amortize it, then you have to amortize it using 6 years. Using 6 years. All right. So let's go and look at it. Let's go and look at it. Okay. So now we have a plant. Additional plant, which is 4,000. Please, let's use thousands instead of millions. Okay. Right. So 4,000 minus 4,000 will give us dash, which is 0. Now there's also an intangible asset. We know, sorry. Okay, there's also an intangible asset, and that intangible asset is 3 million. But before that, let's try and then deal with the additional depreciation before, right? Additional depreciation. So for the additional depreciation, you remember it was 4 years. So 4,000 divided by 4 years will give us what? 1,000. Remember, I made mention to you that we don't depreciate at the end of the year, at the beginning of the year, sorry. So you can't acquire the thing, then you say, oh, I'm depreciating us at that same day. No. you've not used it. There's intangible asset, and that intangible asset, we've seen it to be 3,000, 3,000. And then we are saying that we will attribute it with what? 6 years, for 6 years. So we will use it for 6 years. So it means additional amortization. Additional amortization will be 3,000 divided by 6, and that will give us 500. 500. That will give us 500. So this is what has happened right now. This is what has happened right now. But remember, we said the subsidiary may end up selling something to either an associate or the parent. And if there's any profit in it, they will have to unrealize it, isn't it? So let's go and see if there was some sales from the subsidiary to the parent or any associate. Let's look at it. So we are done with this note, isn't it? So let's go for note 1. We know that note 1 is about consideration. Note 2 is about the fair value adjustment. And then note 3, let's look at note 3. If there was a sale, right? Good. At 30th September 2010, inventory include goods bought from what? Cheddar. So Oba bought some inventory from what? Cheddar. Oba bought some inventory from Cheddar. What does that mean? It means it's the parent who is rather selling to the subsidiary, but it's not the subsidiary who is selling to the parent, right? Good. So Oba had marked up this. Sorry, let's see. Okay, so it simply means that the parent actually sold to Oba. Oba actually sold to the parent, because if you look at this point, they are saying that where is it? Oba had marked up these goods by 30% on cost. Oba had marked up these goods by 30% on cost. You get it? So Oba's inventory include goods bought from Cheddar at a cost to Oba of 2.6 million, and then Oba had marked up these goods by 30% on cost. That is a mistake. This note itself is a mistake, right? Good. This should have been Oba, who is buying from what? Cheddar, and Cheddar being the parent. So it's simply, and here should have also been what? Cheddar. So sorry for that mistake. We'll correct it when we come again. So here, it simply means that there was nothing that the subsidiary sold to the parent. The subsidiary didn't sell anything to the parent. So let's see and then close our net asset schedule. So it simply means that this is the end of the net asset schedule. This is the end of this question's net asset schedule. So here will be 7. This will be 5,000. And then if we have 28,000 plus 4,000 giving us 32. 32 minus 1,000, 31, plus 4,000 giving us 30, plus 3,000, sorry, giving us 30, 30, so 28 plus this giving us 32, 32 minus this giving us 31, 31 plus this giving us 34, 34 minus this giving us 33,500, 33,500, 33,500, right? Then we have 22,000 plus 4,000 giving us 26 plus 3,000 giving us 29,000. So here is 29,000. 29,000. That is 29,000. So now if we have 29,000 and then 33,500, right? So what we have to know is, no, there should be 500 also here. There should be 500 also here for the amortization. So here it's supposed to be 4,500. 4,500. And this brings us to the end of the net asset schedule. In fact, this will not be the last video on net asset schedule. We have about 3 questions that we are going to do on net asset schedule. The next day that we meet, we are going to have a question where we have the P&L. We have what? A P&L. So we'll do the net asset schedule if you have a question on what P&L. And we also make sure we do a net asset schedule if you have a question on what both P&L and the financial position. Because normally there are differences between, so we want students to get to know how it should be what it should be done. Especially when you want to get your retained earning, when you want to get your retained earning. So for this, we will end it here. Then we will deal with a net asset schedule again in our next meeting. So thank you very much for coming. Thank you very much for watching us. And what I want to beg you to do is to subscribe to our channel, watch the videos, and share with family and friends who may also be in need. And if there's anything that you want us to talk about, please, the video is there. You can comment, ask any question that you want. We'll be ready to engage you. Our numbers are also there. You can also deal with it, use it, and then engage us. Thank you for coming. And all what I want to say is let's take care of ourselves. Right. Bye-bye.